Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking oil, nat gas, as well as some of base metal moves as I'm chatting with Darrell Fletcher, Managing Director of Commodities over at Bannockburn Capital Markets. I bring Darrell on to get his take more from the trading desk perspective. Darrell helps some of Bannockburn's clients hedge their exposure to these underlying energy and metals sectors. We also get his insights on recent conferences that he's been at. That's where we're going to start here with LME Week. Happened a couple weeks ago in London. This is really the biggest base metals conference in the world. Darrell, you've been to many LME weeks. Give us a lay of the land. What was this year like?
Hey, Corey, thanks. Yeah, it was great again this week. Past 2 or 3 years, LME Week's been really well attended and a lot of good discussion. If I had to kind of theme it up quickly, it was the three C's. It was kind of copper, China, and carbon. So, in relative to carbon, it's just the transition of decarbonization, how the effect on base metals, which is really interesting. But yeah, it was really good. If you look at those three items, there was a ton of talk on copper and even tin. I think they took a survey during the conference and in terms of upside, they always do a survey and I think copper was first place again this year and like 45% of the vote roughly, and then tin was second. So it was pretty interesting. But I think the other part of the theme was that this is, still, I think as you and I know, medium term, long term play. It's looking for big spikes in copper and things like that on a monthly basis is difficult. So, but the base fundamentals and the underlying markets, medium term, long term, looking at the decarbonization, look really good.
Now, when it comes to copper, as you just said, right, some of these, I guess, more macro drivers, medium to long term, but boy, oh boy, it's all I hear about is how we're going to need more copper and how we're not building these mega copper mines and these big copper mines. They're running long in the tooth in terms of mine life. So, in terms of copper, what are some of more the near term drivers behind copper? Because it did spike back in, I believe, May. But other than that, what sort of near-term drivers should investors be looking at for the copper market?
I mean, on a short term basis, you're pretty much just tracking warehousing inventory numbers. It's really been in limbo price action. If we're looking at just front copper, it's been on like a 30-ish cent range for about a month. And now we're at the low end of that range right now. We're kind of treading this 435, 440 range for the past week or two, but it's been, relatively speaking, kind of boring. Now, back to the medium term, short term, if you look at the forward curves, they're still in contango. So you go 450, 460. So that outlook's reflected in the forward curves. But in the short term, obviously in these commodity markets, participants get excited about big moves quick and then they tamp down for a while and people get bored. But so I think medium term, long term, again, same things we heard at LME week reflected in the forward curves. And it's just, as always, it's going to take time. I think the 200-day moving average on the front is around four and a quarter. So that may be an area to look out for in the short term, given we've just been kind of treading here for a couple weeks on copper.
Any other base metals that you can use even as a proxy for copper or the interest broadly in base metals, even though copper really is the big parent of all of them?
Yeah, and infrastructure and for power is really not a great replacement. I think people would point to aluminum as your second best alternative, but aluminum has other plays, whether it's infrastructure for power, across the board. And that is one thing that really caught my eye last week doing some research at the end of the week on the base metals complex, that both aluminum and zinc for galvanizing have had pretty good months. I'm looking back, aluminum's kind of flattish on the month, but it's been up in that upper range of the 1 to 2 year range. In zinc also, I think there's been some mine issues on the zinc side. But as a base metal complex, to me, everything looks kind of constructive. The LME index is up about 12% year to date. So, copper is going to it's the bigger mover of all of those, and maybe nickel to some extent. But from a complex perspective, I think some of those underpinnings are there and the market's showing it.
What about China then? This is, I guess, a big topic, as you said, at LME week. It's also the country that everybody circles back to and says, what's China doing? Because they are really the largest supporter of metals in the whole world. But we had somebody come on the show last weekend show and say, look, China has a lot of copper. They built all these cities that are empty. They've gone through a whole construction boom. And yes, they're still building out certain, I guess, the initiatives, but overall, how much will China be the key player in your eyes for base metals as we progress a few years out?
Well, it's still going to be large, obviously, a big piece of it. And, all the incentives that have been thrown at that economy in the past month or two, they just keep coming. It's hard to even keep track of some of the incentive packages the government's thrown out there. And so I think that's where the market gets really, you know, very kind of short-term viewed. If they hear something new, copper goes up and then it fades. So that's where I like to look at the forward curve and say, okay, where's the steady state of copper, which, looks more like 450, 460. Yeah, it's not just China though. I mean, a lot of the infrastructure, US, North America, especially a lot of places have a lot of work to do on infrastructure build, which is going to take copper. So, that's a good question. As we get 5, 10 years out, maybe it's not as big a piece, but the fundamental macro things in infrastructure and EV, they're not going anywhere. And back to your point, I mean, mining's not easy. I think anything that can or might go wrong kind of does at times. So I think, and BHP and Vale settled over the weekend with Brazil. Those things are out there all the time.
Yeah, it is. Really, this whole narrative is kind of the slow and steady aspect, I think, rather than expecting some of these price spikes. But hey, you know as well as I do that we'll still hear commentators, especially focused on that sector, saying how copper could get up to 9, 10, even $20. Who knows, maybe even $50. But those are usually just marketing pieces. Let's move over to the energy sectors then. Oil because boy, oh boy, yesterday, Monday, oil sure went through a drop, giving up almost $5 a barrel. It's back in that $67 range. Now, that's closing in on this support right around $65, which is pretty critical support going back a couple years. This all came from, I guess, a war premium coming off the cards a little bit after that Israeli retaliation didn't target, it didn't look like any crude facilities. What's your takeaway from more so just the political, geopolitical price that's built into the oil price?
Yeah, exactly, Corey. That it was quite a bit of a premium, it looks like, because most of the move last week, when we finished back on one above WTI basis, we are only 71.50 on the week. Most of that move was risk premium. At least the U.S. stats here were bearish on the DOE build. It was a much larger build than anticipated, and the fundamentals were kind of bearish all last week, but it was ignored. So we're looking at a 6% sell-off here in one day, and that shook out, basically in a day. So that's I'm a little surprised that the risk premium was 450 here, but apparently it was. So we've broken through. Moving average coming out of the week was about 71.50-ish. So that's gone. The 70-90 range, I talked about all year. Clearly that's gone, at least on the bottom side for now. That had been tested 3 or 4 times in the past 2 months, but it continues to bounce below that. So it'll be interesting. I think you're right. I think the next move might be in the 65 level. Yeah, the risk premium was bigger than I thought. That's a big move. 6% one day. I think it's been a couple of years since we've had that big of a move in one day. And so now, your fundamentals are kind of back in view. It doesn't mean that things can't change as we saw quickly. That wild card, the geopolitical wild card, is clearly out there. Things can change quickly, but it cleared out the risk premium. And the fundamentals are taking back over. You start to look at the things we probably talked about last month, where OPEC says they're going to put barrels back on the market in December. Demand fundamentals haven't been great, so everyone's kind of pointing back to the 1Q25 surplus that a lot of surveys are looking at. So that has also pushed here early this week into the fuel market again, and I've talked about this last time, but diesel and gasoline off 10 cents a gallon here in the US one day, that's a big move. All your forward markets in the diesel market are sub 220. Gasoline's 1.95, $2 wholesale, and it's flat, like really flat. I mean, you go out about 3 years, and that's pretty rare in the fuel market, given, everything being equal, cost of carry money is not free. So to have that flat of a market is pretty interesting. The crude market itself, I think, still has a little bit of backwardation, but it's pretty relatively flat. I think you're out about 65 in Jan 26. So relatively speaking, pretty flat. I've always been a believer when the market's that flat, that long, you kind of get rid of the noise in the front. Kind of tells you where the market likes to be balanced on price. Not unlike copper, you know, being around this 450 range going out a couple years.
So would you say the base fundamentals for oil? Well, I know there's a lot of fundamentals that play into this, a lot of different data points, but broadly, would you say that those are bearish or bullish or neutral?
I think they're bearish now, but I think a lot of that's been shook out of the curve here early this week. So yeah, I mean, that was kind of what we talked about last month, where you're really looking at supply and demand and different survey points. We're looking at this 1Q25 surplus, and that, now it looks like that's being reflected in the curve. So maybe from a price perspective, we hold tight, see if this fills back in the gap or does move to that 65 test level. But overall, it is bearish in the short term right now. But again, things can change fast.
Yes, they can. We all know that. And look, a lot comes from some of these international players too, which they can switch policy on a dime. So it always adds a little more volatility. But again, we're closing in on that 65 level, which is key support. Let's move over to the natural gas market because, boy, oh boy, last week was sure a noteworthy one where natural gas rebounded after a pretty tough month of October, and on Friday just shot way higher. But now today we're seeing natural gas give back a lot of those price moves, still in that about $2.50 range. But look, it's been volatile. Natural gas usually is volatile. Where do you stand on this market?
Yeah, it kind of similar to crude. It had that move up last week, at least on the November contract, which, if you were just looking at the fundamentals, didn't make a ton of sense. We had a big build above expectation. Now, I know Canadian gas is in a good spot for storage. US is, I think we're a little bit above the 5 year average, but I think what the market was looking at last week, at least in the US, was that surplus has been narrowing. Now, given weather, I think we're going to have some pretty decent builds in the next few weeks. But natural gas caught off 10% here early in the week, and November rolls off. December 24 would have been rolling on the board here Tuesday or Wednesday above $3, but now it's below. It's like 280. So this is pretty cheap winter gas. I think early this week here it's reflecting to some extent the move in oil. Production's been creeping up. I think we saw some 102 BCF numbers in production over the weekend, and weather is just above normal, which is, for this time of year is making it, there's just no demand. So I don't know. It looks pretty bearish here for the next few months. I think some of the longer term weather forecasts I looked at into November are also above norm. Calendar 25 about 310, and 26 350, 360 range. So steep contango reflecting, just oversupply in the front.
Okay. Any historical references to what we're seeing then in terms of the supply picture, the demand picture, even inventories?
Yeah, it's not, I'd have to look at the details, but it's not too different from what we were looking at last year in terms of where we are storage in the US. I know Europe, I think European gas had moved higher over the weekend, but I think we're looking at the storage levels to be pretty similar to this time last year. So that just leaves you with weather to look at, which is pretty bearish right now. And, producers keep pushing over 100, 102, then that could get pretty bearish without weather. But again, speaking of things that can change fast, weather would be one of them.
How active have you noticed these markets, whether it's energy, whether it's copper, other base metals, in terms of the trading desk perspective? Have you noticed increase in people trading these things, or have you not?
Yeah, a good question, especially on fuel. I would say we've definitely seen a lot of interest, diesel, gasoline being, near these kind of lower 20, 25 percentile type levels or lower, and just taking advantage of a really flat curve, which doesn't happen that often. Natural gas in the fronts, a lot of interest, obviously, but a lot of that hedging's been done. So it's, to that extent, it's out of the money. And then you've got steepness in the curve on natural gas. So buyers, right or wrong, have a hard time hedging out far when you have a $1.30, $1.20 contango going out about 2 years. They have a hard time looking at that. So it's been mixed, but especially on the fuel side. And then the metal side, it's kind of been neutral. A little bit of interest in aluminum, nickel for sure, and copper's just been kind of steady.
Okay. Daryl, anything that investors should have their eyes on over the next month? You and I chat pretty much every month. So, in terms of catalysts, any major market moves for the metals or energy?
I think in the metal space, the producers, I think the earnings reports are going to be interesting. I think earnings disappointed on some of the major golds last week. Was it Newmont? I think there's some more gold earnings coming out in the next week or two, kind of reflecting higher, sounds like so far, higher labor and just cost structures. That'll be interesting. I think some of the big oil and gas E&Ps have their numbers coming out this week or next too. So I'll be kind of watching that. There's a big data week this week on the economic calendar. And then I think OPEC to see, if they follow through, and I'm not sure when the exact next meetings are announcements, but if they do indeed look to start putting barrels back on the market in December, that may be what dictates this next leg in crude oil if we stagnate here.
Okay. Daryl, as always, thank you very much for taking time to outline how you're seeing some of these markets more from a trading desk perspective. Again, Darrell Fletcher, Director of Commodities over at Bannockburn Capital Markets. Daryl, I'll chat with you next month. Thanks for your time today.
Thanks, Corey.